Hello guys, it's Zekkr. Welcome back to another video, and in this video I'm gonna teach you the ICT 2022 mentorship model and everything you need to know about it. I'll teach you when to set up form, where to set up form, and what 2022 model actually is, right? And at the end of the video I'll give you some insights when trading it, and this is basically it. This is what I'm gonna be doing in this video, and if you're not yet subscribed, make sure to hit the subscribe button. Because why? Because only 5.9% of you guys that watch my videos are actually subscribed. So yeah, it's free, why not? And if you like the video, make sure to give it a thumbs up to help it with the YouTube algorithm. And without wasting any more time, let's hop into the video. Okay, so first we're gonna go through the 2022 mentorship model and the some terms you need to know and what you need to be looking for. So this is the model, right? It's after price sweeps liquidity, so all high or all low. So this is a bearish setup, and I'm gonna show you a bullish one after this one. So I know most of you know what 2022 mentorship model is, but you're missing something out. So I'm gonna tell you in this video everything you need to know. So a 2022 model is a is a liquidity trading model. So you're waiting for liquidity to be taken, right? So as you see here, liquidity run on liquidity started. This is the old high that is right here. You can consider this liquidity high, and then after price sweeps that high, you wait for a market structure shift with a displacement. So displacement is a big, and it's not necessarily big, but it's a fast and sharp move that is decent in size, breaking this short-term low. So what is short-term low in the first place? And it's not the low before the liquidity was swept. No, the short-term low is simple. It's just free candle formation. This is the first candle, right? And then we have the second candle wick being lower than the first, and then the third candle's wick being higher than the second. So this is a swing low, and exactly opposite and reversed is for swing high, right? So it's not the first low before the liquidity swept. It's not necessary. It just this low needs to be swept, needs to be broken down or up, depends on your direction, and it needs to be with a displacement. And when you see the displacement breaking your short-term low, which is here, I'm just gonna remove this. You need to look for a fair value gap inside this move that formed before, or when the market structure shift happens. So this is a market structure shift. MSS is the short word for it. So let's say you have one fair value gap and the second fair value gap. So, and you also have the fair value gap here, right? So what will you do is you will take your Fibonacci, and after this leg has formed, right? Let's say you have this leg going. Let's say this leg is like this, and then you have a pullback inside this fair value gaps, and then you have a distribution to the downside. So you're gonna take your Fibonacci from high to the most recent low, and you're gonna look for fair value gaps that are on or in the premium or discount. Depends on, again, if you're shorting or longing zone of this leg that is displacing downside. So from the short-term high to the short-term low, look for a fair value gap, which would be here. We would enter short. Stop loss would be above the short-term high or intermediate-term high. If you don't exactly know what this terms means, I'm gonna make another video on market structure later, so if you don't want to miss it, subscribe to my YouTube channel so you get a notification. And your target, I don't know, 2 to 1 or liquidity over here or down here. Okay, so you got the model, and now let's look at the bullish one. And as you can see, this is the bullish example. So we have price coming, sweeping some kind of liquidity right here, then creating a creating a market structure shift with a displacement to the upside, and then inside this displacement we look for a fair value gap right here, depends again on the Fibonacci level to enter from. So yeah, you got the bullish model and the bearish model and how you should trade it. And now let's look at the two main keys of this setup: is when do these setups form and where do these setups form. And let's look at where can you find these setups and where does they form, and then we're gonna go to the timings. Okay, so these setups form again if a old high or old low or equal old highs or equal old lows are swept right here. So as you can see, this is old highs being swept, which is a liquidity building up here, being swept right here, and then inside this leg you go to a lower time frame and anticipate this move with a model I told you before. So like this, you break a short-term low, you come back to the fair value gap inside this displacement, and then you target these lows or low right here. So what can you identify as this liquidity? So I said it can be in a form of or low right here. So or low, this can be a liquidity. You can have multiple equal highs, right? Multiple equal highs can also count as a liquidity. And then you can have price coming into old fair value gap, order block, breaker block. It doesn't matter. This is the it should come to the, or it can be old PD array. So as I told you, it can be a breaker block, or a fair value gap, because price treat the bottom of these PD arrays or the top as the liquidity, right? So if this wasn't present, this would be a liquidity, right? Okay, and we anticipate the same model, price coming into this, forming short-term low, sweeping it with a displacement, coming it back to the fair value gap inside the premium, and then going down. So you will take this Fibonacci, fair value gap inside, you would enter short right here, stop loss above this, and target all lows or all highs or liquidity below this. These setups forms, they can form above or below when sweeping above or below the highs of the sessions. So yeah, so now write this to your notes. So Asian session, Asia lows and highs, and it's from 7 p.m. to 9 p.m. We're gonna make this blue. Okay, so it can be Asia lows and highs from 7 p.m. to 9 p.m. They can form sweeping highs and lows from the London session highs and lows. It's from 2 a.m. to 5 a.m. And guys, bear in mind, all of these times are in New York local time. So UTC -5 and -4 in this example because it's daylight savings time, but usually it's UTC -5. But just search here, and as you can see, New York, select that. Okay, and then you also look for highs and lows from New York session highs and lows, which forms from 7 a.m. to 10 p.m. So this is also where you should look for these fair value gaps, imbalances and liquidity. So you look for highs and lows to be swept. Any intraday high and low before 9:30. So this is the liquidity you should look, right? So you should look for liquidity at the lows and highs of Asia session time right here. Everything is New York time, right? From London session, New York session, and look for any intraday high and low before 9:30 equities open. So any low that is formed on the time frame lower than the daily. So I recommend 1 hour or 15 minutes. And I'm gonna tell you when you should look for these setups. So there are two sessions. you hunt for these setups between 8:30 New York local time and between 11 New York local time. This is your AM session. You look for liquidity of highs and lows, as I told you. So from Asia, London, New York session, and any intraday before 9:30 right here. And you hunt for this setups between that time. And then you have the PM session, which is from 13:30 to um, from 1:30 p.m. to 4 p.m. all New York time. So this is the two sessions. You should look for liquidity sweep of those highs and lows. I told you before. This is the key time because algorithms are mostly active during these times, and there's when liquidity is resting most of the time. And now, yeah, you know everything you should know. Now we're gonna look to some live examples, and without further ado, let's go to the example. So, as I told you before, we have our London session high and low right here, right? So you mark the low and you mark the high, and you look for one of them to be swept. And again, we need to hunt the setup between 8:30 and 11, or 1:30 p.m. to 4 p.m. and all of it in New York time. So we have a high swept, right? Price goes up, it do the swing, and then reverses. So yeah, we have the sweep here, but it's not in our kill zone time, so we just ignore that because this is not a high probability setup. But what we see here, we have a low swept inside this 8:30 to 11 operating window. And what do we do now is we mark this low and then we drop to a lower time frame, right? We drop to a 1 minute time frame, and we're in the 1 minute time frame right now. What do you see? This is the exact example I was telling you before. We have an old low right here from the New York session. This is a high probability between our 8:30 and 11 a.m. New York time. We have our liquidity, and then we look for the recent short-term high or short-term low. Where do we see it? We look for a short-term high candle. The second candle of the free candle pattern is the highest of all of it. So this is the short-term high. We mark it, and as you can see, price sweeps it. And with what? It sweeps it with a displacement to the upside. So we mark this as our market structure shift. So this is a short-term high. I'm gonna mark it with this emoji, and then we have a displacement to the upside, and I'm gonna mark it with this emoji. So now we have multiple fair value gaps, right? We have this one, and I'm gonna mark it green because it's bullish. We have this one, and we have this one, this unfilled gap as well. So where do we enter, right? As I told you, if we have multiple fair value gaps, take Fibonacci from high, from most recent high, because there's a fair value gap. If this low filled this fair value gap, then we would use that high, right? If this low filled the fair value gap, we would use that high, but because there's still a fair value gap, we use that high. Because we also need to if we also need to cover all fair value gaps. So as you can see, we remove this candle because it's above the equilibrium, and this fair value gap, as you can see. Now this is not essential, but there's a breaker, right? And this is really important, really high probability now, because we have a breaker aligned with a fair value gap. This is something you should add to your model for a high win rate, but it's not essential at all. So as you can see, this is 50% of the range from high to low, and there's a fair value gap inside this. So we would take our entry from this high. Now where would we put our stop loss? We can put our stop loss below here or here, but there's still a fair value gap. So what we would need to do is put our stop loss below this low, below this long-term low, right? So again, a video on market structure is coming out soon. So we place our stop loss below the recent low, above or below all fair value gaps. So this would be our stop loss. And now what would you target? So we could target something like 1 to 2, liquidity here, 1 to 2. But what I would suggest is taking a Fibonacci from high to low of your dealing range, and then look for a fair value gap above or below a liquidity, and it has to be in the premium discount zone. So as you can see, we have a fair value gap here, but there's no liquidity up below it, right? So we have a low and a high here, but there's no fair value gap here. So we have a high and then a fair value gap right here. This is what we would target, right? Because there's a liquidity above this fair value gap. This is directly from ICT. You target this, and then you could also take partials and target this long-term high, or just take your trade off here completely. So this is the complete 2022 mentorship model. And where do these setups form? When do these setups form? And the thing is right here. It has to, the fair value gap use has to be either in line with the breaker, or it has to be below, above, or on the 50%. Depends on either you're shorting or longing. So this is everything you need. Make sure, if you didn't understand completely, make sure to watch this video again. I know I explained it like quickly, but I really don't want to waste your time, guys. And if you didn't catch all, make sure to watch the video again and subscribe and like the video. So stay safe and see you in the next video. Goodbye.